Hi, want to welcome everybody for joining the call. The CARES Act was just signed into law 1 week ago. Uh, Trump signed it, Friday afternoon, and we've been getting a lot of questions about some of the provisions that are in it. And truthfully, we have some questions about some of the other provisions that are in it. And there's a lot of calls going on, and we're all trying to figure this out. One of the bigger hindrances is, like a lot of federal laws, the law gets passed, and in the details, it's left up to different agencies or departments to figure out the actual mechanics of how these things are going to work. The CARES Act is no different. It is just last night, Treasury Department came out with the terms for the small business lending, one of
Which
those
is supposed
programs,
to start today, right? The
which started
applications.
today, and they just came out with the rules. So, expect the unexpected when it comes to a lot of this stuff. Just as a quick aside, we keep calling it the CARES Act, which is the name of the stimulus bill. The full name is the Coronavirus Aid, Relief, and Economic Security Act. So, God bless Congress. They love their acronyms. Anyway, we want to hit on a few pieces that probably impact our clients and the people we work with the most on an individual basis. There's a lot of stuff talking about how different government programs, the feds are going to help state level programs and things along those lines. We're not going to be talking about that, but there are 5 provisions that as individuals will probably be interesting to know, at least, if not useful for most of us. So the 5 things we want to touch on is, the first one is the stimulus checks. And that's, the thing that's been getting the big headline. Then, I forgot, had a little joke to get everything started, just as we're all stuck at home and doing, trying to make the best of it. Wouldn't be surprised, I know I am, putting on a little bit of extra weight as just trying to pass the time while I'm here. The kitchen's right around the corner, and hey, there's stuff to be consumed. So
Yeah, someone said they need to do social distancing from their refrigerator.
yeah, great way to phrase it. I know I need to. So anyway, yeah, so want to touch on the recovery rebates, which is the official name of the stimulus checks. The fact there are no RMDs this year for people over the age of 72.
What's an RMD?
Required minimum distribution. The law changed this year that says once you got over 72, you have to start taking it. Prior to this year, it was 70 and a half. So if you're 71, there was confusion that, did I have to take it this year? Do I not? And coincidentally, there was some concern that people were going to forget to take their RMDs thinking they didn't have to. Well, now because of this, you don't have to worry about it. So you're fine. Then
And RMDs refer to retirement accounts,
your retirement
401ks,
accounts,
403bs, and IRAs.
IRAs, correct. Not Roth IRAs unless they're inherited, but yes, your retirement savings accounts, if you will. Then third thing we want to touch on is for people who are under the age of 59 and a half and not allowed to touch their retirement savings accounts, whether it's IRAs, 401ks, et cetera, without paying a 10% penalty. There's a new exemption available for this year only, at least at this moment, and want to touch on that. There's also an extension of the 401k loans that you're normally allowed to take when you're working. There are some limits built into that program. They've expanded those limits again for this year to take advantage of, or not to take advantage of, but to help with the the financial hardship a lot of us are going to be dealing with. And then the fifth thing I want to talk about is charitable donations. They've added a new way to be able to get some tax benefit from donating to charity, and just want to make sure everybody's aware of that. So first, the stimulus checks. As we've all heard, or most likely heard, $1,200 per person and $500 for minor children. Couple income limits that required minimum distribution is what an RMD stands for.
You don't have to worry about that until you hit age 72, or if you've inherited an IRA, an individual retirement account, from someone else.
Good, thank you. So most people are going to be able to get the stimulus checks unless you earn too much money. And based off of your adjusted gross income, which is well, at least for the old tax forms, it used to be the bottom of page 1. So once you take into account all of the money you've earned either as wages or dividends and capital gains, plus or minus tax credits or deductions. No, not itemized deductions, but stuff that was on the first page, like the credits you used to get for IRA contributions, for example. So if your adjusted gross income, if you're an individual, is over 99,000, or if you're married filing joint over 198,000, you're not going to get a stimulus check. But as long as you earn less than that, you're going to at least get some. Married filing joint, I think it's at 175 and under, you get the full 1,200, and between the 175 and 198, it's going to be some portion of that. The law actually says for every $100 of AGI, you lose $5 of stimulus.
And married filing joint, you'd each get the 1,200, right? So 2,400 for the couple?
Yes. Plus 500 for kids. So if you've got 5 kids, that's another 2,500 coming your way, for example.
And strangely, the kids are under 17.
Yes. Yeah, it's not 17. It's not, if they're still going to school, there's, they've got the age in there. It's always possible that they're going to make some tweak to these things. Not likely, but if there's a lot of pushback, sometimes there's some last minute adjustments made. The distribution is going to be important for people to understand. They're going to pay out people who get direct deposit first. And then if the IRS, and that's who's sending out these checks, doesn't know your bank information, then they will mail you an actual physical check. And the way the IRS knows your bank account is from your tax returns. If you've either had your rebate directly deposited, or if you had the money just directly pulled from your account, you have to put your bank information on your tax form, and the IRS keeps that on file, and that's the bank account they're going to use to send you the money. So if you haven't filed 2019 yet, and you've switched banks, you're going to want to be aware that at the moment, the IRS is going to send it to the wrong place. Or what the IRS is also going to do, they don't have it set up yet, is set up a portal on their website for you to just directly type in your bank information without having to file your 2019 tax. And I know we're coming up on April 15th, but remember, they've extended the tax filing deadline to July 15th. So you don't have to file, but if the IRS doesn't know your bank account, you're going to have to wait in line and you're going to get your check. And I keep stressing that because direct deposit gets paid first, expected to start here in the next week or two. They're figuring it's going to take 3 or 4 weeks to get that done, and only then will they start mailing the checks. And since they're only going to be doing about 5 million checks a week, physical checks, it may not be until late September for everybody to finish getting paid out. So there's a lot of incentive, I would say, to make sure the IRS knows your bank account, just so you can get the money sooner. Now, if you earn $300,000 a year and you don't want the IRS to know your bank account, you have no incentive to let them know your bank account, obviously, because you won't be getting the check. That's, quick recap on the stimulus checks. And as you have questions, please just either type them in the chat or even just take yourself on mute and just ask it out loud. Seems like we got a small group today, so don't be shy. RMDs, required minimum distributions. So you have to take it every year once you reach a certain age or you inherit a retirement account. And part of the CARES Act is the suspension of that for 2020. So if you have to take one this year, you no longer have to take it. If you have already taken it, you can put it back into your retirement account if it's been within 60 days. And then you just use it's considered a 60-day rollover, which you're allowed to do once every 12 months. If it's been longer than 60 days, you can't put it back. It's just going to be cash in the bank and nothing you can do, unfortunately.
Although go ahead.
No, go ahead, please.
I read that you could have 3 years to put it back if you're affected by the pandemic.
That is actually going to be under the CRD waiver.
Oh, my bad. Okay.
So that is, well, I'm glad you brought that up because there's a lot of confusing the RMD rules versus this 10% penalty waiver that I'm going to get to. So, I'm glad you did that. I'm glad you phrased it that way. And like I said, no RMDs also apply to inherited IRAs. So, if you're 30 years old and you inherited your great uncle's IRA, you don't have to take the RMD this year that you've had to take in the years past. Now, this is very similar to what happened in 2009, that, they had a holiday for RMDs because they didn't want people having to liquidate investments at the bottom of the stock market. But what they've done this time that they didn't do in 2009 is they gave some people who are 70 and a half a break. If you turned 70 and a half last year, you had to start taking your RMDs. Most people are going to take that in that first year so they don't get double hit the following year. Let me take a step back. That first year you have to take your RMD, you actually have until April 1st of the following year to take that full amount. So turned 70 and a half in 2019, you didn't have to take it until, 2 days ago. You could still have taken it and it wouldn't have been a late distribution. Most people don't do that because you're going to have a distribution in 2020. So why have two distributions and have this bigger tax bill? But some people don't, either by accident or intentionally. And the CARES Act has said, if you haven't taken last year's RMD by the time the act was passed, you didn't have to take the rest of it. So if you needed to take $10,000 last year as your first RMD and you hadn't taken it, you didn't have to complete it, which, helps some people, may irritate others, but, it's a little wrinkle. And now that it's April 3rd, it doesn't really impact anybody at this point. But, something worth pointing out, I think. And I'm going to get to it later, but it does get drawn into confusion a lot. QCD, qualified charitable distributions, which allows you to send money out of your retirement account directly to a charity, and it doesn't count as income, but it counts towards your RMD distribution, for example, is unaffected by this RMD waiver. They're two entirely different programs, two different sets of rules, but in a lot of people's minds, they get combined. So I want to, point out that QCD still exists. If you want to use it, you can use it this year, and IRS isn't going to care. Next one has potential to get a little confusing, or can get some people in trouble. The coronavirus related distribution 10% penalty waiver. So if you're under 59 and a half, you're not allowed to take money out of your retirement account unless you have certain things come up. And this year, the CARES Act added another 10% waiver to avoid that 10% penalty for taking your money out early. And quick point is the distribution is still considered taxable income. You just don't have this 10% additional penalty that you have to pay. So, but who qualifies for this CRD waiver? Well, if you get the virus, if your spouse or a dependent gets the virus, clearly that you're considered to be affected and entitled to the distribution. Then they have this third way to do it, is if you have adverse financial consequences. And it's a big quote that I have underneath, but this is the actual definition in the Act of adverse financial consequences. And as you can see, there's some stuff in here that's very specific, that, you know, you are laid off, or you can't work because you have to stay home and take care of the kids because you can't use daycare. But then there's some stuff that could be a little vague, as if you're having issues with your business, you know, and who's to say your business is impacted by the coronavirus or not. You don't hear a whole lot of people talking about it, but I'm just wondering if in the next couple years, there's going to be if in audits or something, the IRS pushes back and says, we really don't think you were entitled to this. I don't know how it's going to play out. I don't know how much they're going to ask these questions, but I do point out, don't say, for example, for me, you know, just because I'm, you know, forced to work from home, am I necessarily financially impacted by the coronavirus? Probably not, at least not yet, fortunately. So, you know, if I was to get audited, could I make some sort of argument? Maybe, maybe not. Would the IRS accept it? Maybe, maybe not. I'm not going to take the chance. So if you definitely meet one of the specified criteria, by all means, use this if you want. But if you are pushing the envelope, just beware that, you know, the IRS may end up taking a look at these things. So please be careful for that.
Yeah, the advice I've seen is, you know, document everything. If you were seeing a certain number of clients beforehand and it's been reduced, you know, make sure you've got ways to show that.
Yes. I've been to a few, and I'm glad you brought that up, Stephanie. I've been to a couple IRS conferences, and every time the single piece of advice you hear throughout all of these things is document. If you have it documented, it's a lot easier to defend your position. So yes, document, please. The next thing is, before we get to the charitable donations, 401k loans and 403b loans. So
can I ask a question first?
Please.
On the coronavirus related distribution, let's say I'm forced to take some money out of my IRA. I don't have to pay the 10% penalty, but I will owe tax.
Oh, criminy. Yes. Yeah, so there's kind of a big feature on the CRD. Thank you, Stephanie, for politely asking it as a question, as opposed to just saying, hey, you fool, you kind of forgot a key part.
Well, I can't kick you under the table because you're far away.
True. And my shins are grateful for that. Anyway, the other part of the CRD penalty waiver is a 3-year rule. in which they say, if you take the money out, you actually have 3 years to put it back in if you choose to. And you also have 3 years to pay the tax on the distribution. Now, what's not clear yet is, and these rules will come out at some point, gets back to one of my early comments that they pass the law and then leave it up to the different agencies to figure out the mechanics. Here we go. We don't know the mechanics yet of, is it going to, the 3-year, paying the tax over 3 years? Is it going to be a third, a third, a third? Do you just have to pay it all in over within 3 years? We're not clear on that. We're not clear, how do you get the money back? Say you pay, you pay the tax, and within in the third year, you put all the money back in. How do you get the refund on the taxes you'd paid in years 1 and 2? We're assuming you'll be able to, but we don't know those details yet.
So just to clarify, when you say putting the money back in, right? As an example, let's say I've got a $100,000 IRA and things are really tight. So I'm going to take out $20,000 this year. And then
Right.
I'm not going to owe 10% penalty because I was affected by coronavirus and I've documented that. I have 3 years over which to pay my tax on the income tax on the $20,000 I've taken out. But let's say in year 2 or year 3, things are going really well. And I'd like to kind of make up for that withdrawal, right? I'd like to kind of erase it and get back to where I was. I can put on top of whatever other limits there are on my retirement plan contributions, I can kind of roll over, I think is what they technically call it, my $20,000 back into my IRA if I'm financially able to. And then
Correct.
that's what Kevin's saying. We're not sure exactly how you reverse that tax that was calculated and owed. That will be done. Ordinarily now you have a 60-day period. If you take money from your IRA, you have 60 days, you can put it back in without owing tax.
Right.
Like a whoops, sorry, you didn't mean it, and no harm, no foul.
Right.
So they've extended it to this 3-year period.
Yes. And we're talking about money that's physically removed from, or I guess actually removed from the account, not buying and selling within the account. We're talking about actually taking a distribution. You get a check, either electronic or physical, in your hands that you're going to do something with. Another point to be aware of is the IRS has said there's a 60-day rollover rule that you're only allowed to do it once per 12 months. Well, this putting the money back into a retirement account that you have over 3 years, is this going to be classified as a special 60-day rollover that doesn't interfere with the other 60-day rollover? We don't know, but be careful with that because if you do 2 within a 12-month period, the second one is disallowed by the IRS. It's considered a distribution, and then it's an overcontribution, and that creates, not only does it generate more taxes and penalties, but it's also a pain in the butt to do on your to file the adjustments and corrections. So I think now, okay, so that covers the 3-year rule. So retirement plan loans. If you're working and you have a retirement plan at work, you're allowed to take a loan from it, assuming, and this is a key part for retirement plan loans, if your plan sponsor allows it. Just because the Department of Labor, who actually governs 401ks and 403bs, just because they say you're allowed to do something doesn't mean that feature is available on your 401k. Your plan sponsor also has to incorporate that into the plan documents and allow for that. For example, you're allowed to take 401k loans, but the company you work for may not allow it, and that's their prerogative. But if they do, you're restricted on how much money you're allowed to borrow at a time. And that restriction is the lesser of $50,000 or 50% of your account value. Well, CARES Act has come in and said, listen, times are tough, people may need more money, so they've expanded those limits. It's now the lesser of 100,000 or 100% of your retirement account balance. Keep in mind, I keep saying 401ks and 403bs. You cannot take a loan from an IRA. They're not part of this. This is, your a retirement savings plan that you have with your employer. And the other thing that the CARES Act has done for retirement plans is they've said you don't have to pay it back this year. You don't have to. Once you take a loan, you have to make periodic payments on the loan, just like you do with any other loan. Well, CARES Act has said you don't have to this year. And again, if the plan sponsor adopts this provision, your new loans that you take out, you can skip your monthly payments, but interest will accrue. And this also applies to existing 401k loans. So if you took one 2 years ago and you're still paying it off, you're allowed to, or I should say, the provision exists that allows for this, your plan, your company to say, you don't have to make payments for the rest of this year.
Kevin, yes. It's 12:30. I don't know if people have to jump off.
Crap.
So do you want to hit the charitable real quick?
Yes.
And then we can circle back and open for Q&A?
Yes, thank you. So charitable donations, and you can donate to charities however you want, but the IRS is only going to allow you to get credit for that a couple different ways. First one I briefly touched on, qualified charitable distributions, which is QCD, which is money that comes directly out of your retirement plan to a charity. And the rule is you don't get a deduction for it, but it doesn't count as income either. So, if you, $10,000 to American Red Cross, if you do it as a QCD, it doesn't count as income, as opposed to you take the money, you withdraw the money from your IRA and you write a check to the Red Cross. That $10,000 you took out is now considered income. Maybe you do, maybe you don't get the deduction for it, but it's income. By doing directly with the QCD, you just avoid the income issue altogether. The second way you can get a tax credit for charity is if you itemize. And the IRS has expanded that definition this year. A couple years ago, when they changed the tax law, they curtailed the amount of tax credit, the deduction you get for making a cash charity contribution to 60% of your AGI. They've expanded it this year to 100% of your AGI. You'll be able to itemize. So that's, a nice little bonus. Then the third option is brand new, and it's going to be for this year only. It's an above the line deduction, in which they say if you just take the standard deduction, you don't itemize, you're still allowed to take up to $300 and get a tax credit, or tax deduction for that contribution. Like I said, up to $300. $350, you don't get it. You don't get it for the 50, you get it up to the 300. So what you might want to do, if you still want to make a charitable donation out of your retirement account, first $300, go ahead, just write it out of your savings account so you can maybe get that deduction, and then over and above, do a QCD. I want to stress that this above the line deduction of $300 is only if you take the standard deduction. You cannot get an itemized deduction for part of your charity and the $300. It's an either or situation. So my comments went a little bit longer than I intended, but hopefully everybody may have some questions, and fire away. Please ask.
Yeah, jump in. You either unmute yourself and chat, or unmute yourself and talk, or you can write it in the chat. So
one interesting thing about the RN RMD waiver is there's a 5-year rule if there's an inherited IRA that went to a non-person. So if the beneficiary for non-person, so if you said a charity will be the beneficiary, or if you just wrote in my will is the beneficiary,
or my estate,
or certain trusts that don't qualify for the see-through provision, the IRS rule says within 5 years that money has to be emptied out of the account. With the RMD waiver, it's essentially now a 6-year rule because they're allowed to skip this year. So you now have an extra year to have that inherited IRA or retirement account emptied out. However, it does not apply to an inherited IRAs that start this year that fall under the 10-year rule that just got created for, say you inherited from a parent and it was just happened this year. Under the Secure Act that was passed a few months ago, the law says you now have to empty that account out in 10 years. It was specifically discussed in this act that you do not get an extension of that 10 years as a result of this RMD being waived. So that's a potential hurdle that some people are going to probably get tripped up on at some point. But
they can never make these things simple.
No, they've got to have, well, they keep adding, every time you add an exemption here or there, then you got to remember that exemption or special situation exists the next time you pass a law and account for it. I mean, the only reason people are even thinking to comment that it applies to the 5-year rule and not the 10-year rule is because it was originally written in the bill for both of them to get the benefit from this RMD waiver. But because they specifically took out the line or the language for the 10-year rule is the only reason most people even noticed. So it's always something that's going to trip us up, and they keep finding ways to do it. So
yeah,
anyway,
all these retirement plan rules are crazy complicated.
Yes.
No questions, anyone?
No. Let me throw in one more thing about RMDs just to fill up a little bit more time. But
he'll keep talking unless you interrupt him.
I don't shut up easily. 72 Ts. If you take, there is yet another way to tap your retirement accounts early. It's called the 72T, substantially equal payment, which says, and there's certain requirements that you've got to do it for at least 5 years, and it's got to go until you're at least 59 and a half. But you're allowed to tap the money early without that 10% penalty if you follow this very strict distribution plan. But 72T payments are not exempt from the no RMD rule either.
So you still have to take them if you're in one of those.
Take that payment. And that is a program that if that gets messed up, the penalties can be very severe because they go back to the beginning of the program and all the money you take in is considered early distributions. And then you may deal with underpayment penalties. And, you know, we've talked to a couple of clients about it, but it's a very specific and complicated program that you want to be really careful with. So if you have a 72T, first of all, you know you have it, and be very careful with it. If you have any questions before assuming something applies to you, please verify that.
Question on the charitable contribution for the $300. If you're married, do you get twice that?
No, it's just $300.
Per household?
Per household.
Well, that rots.
They've been good lately about not penalizing married couples, but yeah, they kind of let that one. They kind of let that one slip through.
Thanks for asking, Seth. I hadn't thought about that one.
Yeah, that was. But now I'm turning around and I'm just going to bear with me for a moment because I'm going to double check myself on this one.
So I would say everyone just, stay tuned. There are other provisions from the CARES Act to help small business owners, independent contractors, self-employed people. Kevin and I are working on learning more about that. I've got a call Monday to learn more about that. So, as we get more info, we will try to be out there. Anytime you've got questions, please reach out. You know how to find us. We're all working from home, as you can see, but we're working. Yeah, hopefully you found it helpful. We'll do a recording and send it out to folks.
Yes. Appreciate everybody coming in, listening. I hope this was helpful. And yes, please reach out to us if you got any other questions.
All right.
Thank you.
Thanks, everybody.
Thank you both.
Take care, Alan.